class, having the largest asset manager in the world with over $1 trillion of assets under management, decide that Bitcoin is a worthy investment, really, I think, to help legitimize the asset class.
Your distribution channels and distribution network really strong when it comes to BlackRock, and this compression of margins forces smaller players out of the game.
During periods of macro stress, European allocators in Switzerland, Germany, and the Netherlands have consistently bought US allocators sold, pointing to structurally different investor behavior across markets.
It all comes down to education as well. I think wealth managers, private banks, they're realizing they might lose out versus competition as well. And there's a certain pressure from the final client too, which is definitely helpful for us. And the ETP is also a beautiful instrument of keeping assets in-house rather than losing clients to direct crypto.
If you were to say 5 years ago, a company like Tether would be the 17th or 18th largest holder of US treasuries in the world, above countries like perhaps Germany and South Korea, no one would believe you. But today, that's the reality.
When we do staking, the underlyings never leave the cold storage. They're still there. So it's not. This is also an additional safety layer. Plus, there's an insurance. I always say it's ETPs might be the safer investment vehicle than going direct.
People tend to fear what they don't understand. In the case of staking, there are so many different flavors of staking. All the flavors include a programmatic element, which is far more transparent than sometimes some of the yields with fixed income that are tied to opaque rating agencies.
Welcome everyone, and thank you for joining me today. I would like to begin with some context. I will provide some context about crypto ETPs, about crypto ETP market. It has grown far beyond any single region, and today's conversation is about where it goes from here. We have 4 guests at the virtual table who are building, researching, and allocating in this space from different angles. Over the next hour, we will get into who is building and why, what staking inside the regulated ETP wrapper looks like as regulators move to catch up, which product structures have real institutional demand behind them, and what it will take for advised wealth to start moving into this asset class at scale. I'd like to ask our guests to introduce themselves, and let's begin with Andrew.
Hi, my name is Andrew Forson. I am the president of DeFi Technologies, which is the parent company of our wholly owned asset management subsidiary, Valour. Valour is predominantly an exchange-traded product provider that operates within Europe. We have products listed on approximately 9 exchanges. That includes many of the main European exchanges in Brazil. We have 74 of those products are single digital asset underlying, and 28 of them are more sophisticated hybridized products, predominantly all in the digital asset space. It's a pleasure to be here. Thanks very much, Nasib, Bernhard, Igor, and James.
Yeah,
Hi,
Bernhard? Yeah, Igor.
I don't want to jump in if you have a order of
There is no order.
introduction. Okay. Hi everyone. I'm Igor. I'm investment director at Venionaire Capital. I'm focused on digital assets and Web3 infrastructure. My company, Venionaire Capital, is a VC company headquartered in Vienna with focus on fund services, strategy, management, M&A services, corporate finance, strategic advisory. My department is focused on digital assets and blockchain industry in general. My team invests capital into startups and scale-ups, across the blockchain stack, which means L1s, L2s, app chains, middleware that connects them all. But we also build regulated financial products that bridge crypto and traditional markets, specifically customized EU BMR compliant crypto indices that are in part listed on Bloomberg and Refinitiv, designed, of course, to underpin ETPs or ETFs in general, but also includes decentralized ETFs, so-called DTFs, which were also launched last year. I'm happy to be here. Thank you.
Yes, I guess we can continue with Bernhard.
Yeah, thanks for the invitation, Nasib, and great to see everybody. Bernhard Wenger is my name. I'm head of Northern Europe at 21Shares. 21Shares, we are a crypto asset manager, really focusing on exchange-traded products. We're doing this for 8 years now. We're one of the larger players in this field. We have offices in Zurich, where I'm based, London and New York. And in Europe, we've currently 60 products. It's single cryptos, baskets. We have a couple of special products, for instance, Bitcoin and gold. And really, yeah, glad to be here and looking forward to the conversation.
Thank you. James?
Hi, James Butterfill, head of research at CoinShares. CoinShares is one of Europe's largest digital asset managers. We pioneered ETNs, so what a type of ETF, I suppose, or ETP, back in 2014, 2015 in Bitcoin, and I've grown a lot since then. We have about $8 billion of assets under management in various different cryptos, predominantly Bitcoin and Ethereum. And we also have a blockchain equities ETF, UCITS ETF as well. We are a NASDAQ listed company now, and have operations in the US, Paris, London, and Jersey.
Thank you very much. And to quickly introduce myself as well, my name is Nasib. I'm a PhD researcher in the blockchain space. And at the same time, I'm working on this media project focused on institutional crypto intelligence. There are predominantly two formats that I'm delving into, one-to-one conversations and the webcast roundtables, and that eventually turn into intelligence reports which will hopefully help people in the industry to gain more useful insight that will help them in their professional activities. Now, we will spend the next hour in an open roundtable format, right? Focused on the ETP market, as it has already been established, ETP market and where it is headed. So let's get right into it. Before asking a question, I think it makes sense to provide some context every single time. We have 5 main questions. So BlackRock's European Bitcoin ETP crossed $1 billion or $1.1 billion in assets under management 2026, just over a year after its March 2025 launch. Amundi as well launched its own Bitcoin ETP on Euronext Paris on April 24, 2026. The first such project approved by France's AMF. According to CoinShares on Q4 2025 13F analysis, investment advisors have consistently accounted for the majority of for the majority of reported institutional Bitcoin ETF holdings throughout 2025, with advisor exposure up to 34 or approximately 35% year on year by end of Q4. Now, for firms that have been building in this space for years, what does it mean when the largest asset managers in the world decide crypto ETPs are worth showing up for globally? Does their presence validate the market or compress the margins of everyone who built it?
Is that a question to anyone?
Yeah, everyone.
Okay, I'll start. I think it's both. I think it validates the asset class. Having the largest asset manager in the world with over $1 trillion of assets under management decide that Bitcoin is a worthy investment was actually in the United States in particular, back in the start of 2024, really, I think, to help legitimize the asset class and gave investors the confidence to add to Bitcoin. So in many ways, I really welcome it. Bernhard from 21Shares and myself, we both actually used to work at ETF Securities, and there we had gold exchange traded products, and there was a bit of a race towards very low fees there, and so it's kind of inevitable that at some point you're going to see a race to incredibly tight margins in the space, and I think it just represents the maturity of the asset class to some extent, and maybe businesses have to start sort of focusing away from Bitcoin and other assets. I mean, it's clear at the moment BlackRock just want to focus on Bitcoin and a little bit of Ethereum and not much else at the moment. So, commercially, And also, I think there's great opportunities in other assets too. But yeah, it's definitely squeeze margins for everyone in the industry.
Yeah, I agree. Actually, I wanted to just basically say the same. Both this compression, I think, however, might be a temporary characteristic because we have more and more altcoins, ETFs coming into the market, and I think this forces a certain differentiation when it comes to wrapper, because now you have, of course, products with staking yield baked in. James, your products are basically at 0% TER. So do you combine non-staking assets with staking assets? How does that affect your TER? So there are a lot of moving parts, and it is still, I think, early, but this compression, I think, will be also temporary, and it is relevant if you're just comparing the single asset products, for example, BTC or something like Litecoin that does not have the staking yield component to it. So in a way, what IBIT has with 0.15%, if I'm not mistaken, this, I think, in a way resets European pricing. Very, very curious to see how this goes, of course, especially with the MiCA 2.0 in sense, which should be a theme for the next year at latest.
Yeah, I think. Can you hear me? I had a strange noise here. I think I can also echo what was said by James and Igor. I think what is, because James mentioned the analogy with gold ETC. I think ETCs. I think the credibility of the asset class is growing significantly when institutions like BlackRock and now also Amundi enter the market, because um, when the gold ETCs were invented 15 years ago, a bit longer, I think once BlackRock entered the market, the overall cake was just growing, and the credibility of gold as an asset class for institutional investors was growing. And I think the same is happening and will happen with Bitcoin. So ultimately, it's very positive. And I also agree with Igor. I mean, on the forefront of innovation, if you have new ideas, new underlyings, then the margins will a bit juicier. I think on Bitcoin, this is really a race to the bottom. But this is also at the end of the day expected. And if you look at the flows overall, be it in Europe, be it in the US, it's probably also warranted.
Yeah, I mean, I think anytime you're dealing with a commodity, you will have compression as there are more players that join the market. But I think the critical point is there are also more capital inflows in total into the market. So to some extent, that offsets the impact of compression. And there's greater familiarity with the broader digital asset space. And increasingly, I think we are also seeing that the sense of utility associated with digital assets is not just a speculative investment product, but more and more there are many tokens that are really the gas fees of what are the rails of the new modern finance. So where Bitcoin was the doorway for institutional adoption and for broader retail acceptance, we're also seeing new opportunities come up with products like Hyperliquid, which is a perpetual futures chain, which offers significant yields and returns and is somewhat independently correlated or negatively correlated to an asset like Bitcoin. So whilst there are commodity products which will have compression, I think it is generally a good thing when more capital is flowing into the digital asset space, regardless from where that capital comes from, because that should result in increased prices. Even in a week like what we had last week, prices are still historically considerably higher than they have been. And that can only happen whenever you have more capital inflows from a broad range of sources.
I mean, yeah, I agree with everybody. The one point I'd like to also address is the mode of distribution and your distribution channels and distribution network, which is, in my humble opinion, really, really strong when it comes to BlackRock, and this compression of margins in that case pushes maybe or forces smaller players out of the game, because the scaling is all dependent on your distribution network and how strong you have of a network. So in that case, or in this sense, I would argue that BlackRock definitely wins when it comes to distribution game, but maybe not just the price. And not sure how European providers are going to compete in the long run, how sustainable this competition or participation would be. So,
well, I think this is an important debate we're having, is how do you compete, and perhaps it's being about more sophisticated, being very selective about which tokens you choose. There's an ongoing cost of having many different tokens in an ETP structure. So focusing on those with a really credible investment rationale. So hype was mentioned. That is one of those, I'd say Doge isn't. So you focus on those where you can achieve better margins. And then maybe the next solution is finding more sophisticated type of investments, maybe active, or maybe sort of very sort of high quality systematic type strategies that might appeal to investors as where the margins can be achieved.
Yeah, I think that's a very good point that James raises. You have to look at the business that we're in as not just digital assets or crypto, but we actually are platform operators. So that means we are a medium through which these structured instruments move from a digital asset marketplace to the traditional marketplace. So if we step back, and if you were to step back and look out, say 50 or 100 years from now, what does the business model look like? Well, all of a sudden you're able to leverage new technologies. And without a doubt, the idea of a single underlying instrument is less appealing, but we certainly are capable of producing more sophisticated basket portfolio instruments, instruments that are targeted at a particular strategy. And this is common. This sort of maturation has happened in the equity space, has certainly happened in the commodities and the FX space. We're seeing it happening in the bond space. So I think as the digital asset industry continues to mature, yes, we will be having to diversify or evolve.
Thank you very much. I have a very interesting question, and it's connected to Mika. But before, again, I will provide some context. The European Commission launched a public MiCA review on May 2026 with staking, lending, and DeFi explicitly in scope. The consultation runs until August, and the grandfathering period for the pre-MiCA crypto service providers expires, if I'm not mistaken, on July 1st, with over 200 firms now holding full CASP authorization across the EEA. In some member states, the authorization pipeline is either blocked or has no regulatory infrastructure in place to receive new applications, leaving operators with no path to compliance before the deadline. This is the one question specific to the EU, right? And what does the regulatory picture for staking inside the European ETP wrapper look like at the moment, right now? And where do current gaps leave product issuers exposed before any MiCA update arrives?
I mean, one of the things that come immediately to mind is how this framework is going to affect those who are focused as a business, focused on mining or validating nodes, offering validating nodes or validators as a service. How they are going to be defined? Are they are going to be defined as something unauthorized? How they are going to interpret staking in a regulatory context? And how is this going to then maybe possibly negatively affect any existing ETP yield mechanism, which might collapse if there is no regulatory clarity, or at least sufficient regulatory clarity. Because when it comes to validating nodes, there is always this risk of slashing, which also has to be addressed in an appropriate manner. Staking yield is not really free money, and how staking works on a fundamental level, and then how it is translated into an ETP or ETF as a product has certain risks to it. And so how do you deal with that in a regulatory manner and as a business provider at the end of the day? Because as an issuer, you have to have professional custodial services. So are they insured as a business? Because slashing is very expensive if it happens. So I'm not sure if MiCA 2.0 is going to address this in an appropriate manner or in a timely manner. But it should, or it would be great to have this clarity, because otherwise EU would maybe even lose on competitiveness, or even risk to fall even further back compared to US markets, for example.
I think in the current product setup, or how products are structured in Europe, I mean, the ETP itself is not really being influenced by MiCA. It's a different regulatory environment. They're already regulated, and it's more how the inside is structured. You were referring to the staking providers, but there are already safeguards in place nowadays. We must also be fair to our products. I think there was not a single slashing case in all staking ETPs so far globally, which is also important. And obviously, issuers do their homework. Who are their staking providers? If there's a regulatory change or a MiCA change influencing which staking providers you can work, definitely this will be addressed. We had the same with the custodians, with the crypto custodians itself, where there was no regulation before, and then the regulation came into place. And obviously, as an ETP issuer, you can react and really work with the right counterparts. And then in addition, what I think also important to understand is when you have a crypto ETP, at least at 21Shares is the case, but I guess at other issuers as well, is when we do staking, the underlyings never leave the cold storage. They're still there. So it's not. This is also an additional safety layer. Plus, there's an insurance. I always say it's usually ETPs that might be the safer investment vehicle than going direct, especially on the staking side, because staking is very complex for final investors, and this complexity is taken away by the issuer. So I think it's net positive, and obviously we are monitoring regulatory developments, and once there are any additional regulations in place, all the ETPs in the market will follow suit.
I'd have to agree with both Bernhard and Igor. I think one of the things, Nasib, that we have to keep in mind is that the regulatory frameworks are actually done iteratively, meaning they interact with us and we interact with them. So this is one area where I think the ETP providers have been proactive in terms of safety, in terms of making sure the assets are within our control, and in terms of making sure that no risk or no undue risk is being taken with regards to how assets are managed in staking. And then we, in turn, we explain what we want to do with the regulators, the exchanges. We highlight all of this quite transparently in our prospecti, and we create the investment product. Now, sometimes it takes time if you want to make something innovative or slightly different, but the fact remains is we tend to be the ones who initiate the structure. And then after you get a range of these products, the regulators pick up on it, and they in turn define something that can be applied industry-wide. I think staking is a fact of life. As soon as networks moved from proof of work to proof of stake, all of a sudden that became a critical element of the ETP investment journey. And certainly that's something that I think all of us as asset managers take into consideration from a regulatory side and an operational side.
Yes. It's nice to see you back, James.
Yeah, sorry, a few IT problems. I missed the questions.
There was just this same question, because the same context that European Commission launched public MiCA review, right, with staking, lending, and DeFi explicitly in scope. Consultation runs until August. The grandfathering period for pre-MiCA crypto service providers expires on July, with over 200 firms now holding full CASP authorization across the EEA. In some member states, the authorization pipeline is either blocked or has no regulatory infrastructure in place to receive new applications, leaving operators with no path to compliance before the deadline. And the question was that this is the one. The question was focused exactly on EU, right? So what does the regulatory picture for staking inside the European ETP wrapper look like right now, and where do current gaps leave product issuers exposed before any MiCA update arrives? Do you have anything to to add here?
Not too much. I mean, staking, I think actually we're ahead of the United States in terms of staking already, and they're fairly efficient structures. So yeah, I mean, when it comes to DeFi specifically, which I think is maybe slightly different, creating that in some sort of ETP structure is particularly challenging. You run the risk, if you don't have full KYC and AML procedures, you run the risk of theoretically lending to terrorists if you don't have some sort of quite elegant solution to offering a really good quality yielding product, for instance. And then obviously there's a reputational risk with DeFi at the moment. It's had quite a lot of hacks, so I think it's very complex. But from a staking perspective, I do think Europe is actually ahead of the US in this respect, particularly in the way it treats things from a tax perspective.
But Nasib, I think we should distinguish between pure network staking, as in validating a blockchain network as a proof of work instrument, and generating yield from perhaps lending activities, which I view as slightly different. Actually, I view it as quite different from staking. I think the regulatory requirements, depending on what you're doing, if it's pure staking, it's one thing, because there are many options, from running proprietary validator nodes to working with staking providers to optimize how the digital assets are held and managed for proof of work generating yield. That differs, in my view, from doing a balance sheet transaction, which requires loaning out assets and generating yield, and thereby exposure, as James said, to potentially counterparty risk or KYC related issues.
I 100% agree. I mean, lending and staking is a different risk profile. And imagine with staking, like I said before, you don't lose, or you don't lend out the underlying crypto. It's still within your custody, cold storage, right? And when you do lending, at the end of the day, you lend it out, it's gone, and you get a collateral, for instance. But that's a different risk profile. I think staking is, in my humble view, much more secure, and you have safeguards. Like I said, you had 0 slashing events so far in any ETP globally, and there's an insurance as well.
I think the way I see this is I think when Bitcoin ETPs were launched back in 2015, they were actually incredibly challenging to do. There were no market makers around, so you had to make your own market. There were no custodians, so there are a lot of challenges there. And I see the DeFi side of things. It can offer incredibly attractive yields, obviously with a level of risk, but it's technically very challenging to deal with those AML procedures. But I don't think it's insurmountable. There's some very interesting solutions coming up. So there's a company called Keyring, for instance, that do all the KYC and AML at the onboarding of a client. So, and then there's zero knowledge proof throughout the chain of that client's AML and KYC. So there are definitely solutions there. I see it sort of similar to when the Bitcoin ETFs launched for DeFi right now, that it is technically challenging, but not insurmountable.
Yeah, I agree really with everybody. It's very interesting discussion. One point I'd like to add when it comes to staking is that the underlying mechanism of staking is on a protocol level comes from the protocol inflation. So this also has to be kept in mind, because if I have let's say 8% staking yield, which is dictated by the inflation, which is baked in the protocol itself, but the price of the underlying has plummeted 90% within 1 month's time, then on the surface, this sounds nice. I have 8% yield. ETP is passing through this yield to me as an investor or a client. But at the end of the day, the underlying still can suffer, price decline and still suffer under very high volatility as an underlying asset. So this is something that perhaps not, or maybe the majority of the ETP buyers, the investors are really not considering how this staking yield is generated, where does it come from, what does it actually mean, and how does it reflect the circulating amount of units of any protocol, whatever it may be. So this is also something to keep in mind, because it affects the sustainability, the longevity of an underlying over the period of 1, 2, 3 years. ETPs are there to, for a longer period as a product, not to be there for a few months and then shut down and pull off the market.
And I'd also add the distribution of these assets. So we're just getting to a place now where most clients are getting comfortable with Bitcoin and maybe a few other cryptocurrencies. Having to articulate the kind of technicalities of decentralized finance is going to be quite challenging in that respect. And it could take a long time before we see some broader institutional acceptance of this part of the industry.
But on a positive note, these innovations, I mean, it's not even innovation whenever you consider that the underlying price might move differently from the yield that is generated, as Igor mentioned. Most of the time, the yield is generated in the form of the native token, but the underlying price does move based on supply, demand, the performance and revenues of the underlying chain. That is not necessarily a bad thing, because what it does do is it gives rise to being able to invest on the basis of a strategy. This is no different from the fixed income industry, where you have bond prices which vary with interest rates, but the yields are set according to the actual bond. When you have more innovation in the industry, I believe it enables more opportunity. But James is correct. When people don't understand either the technology or the mathematics behind the structures, then of course, people tend to fear what they don't understand and think that the risk level is higher. In the case of staking, There are so many different flavors of staking, but what all the flavors include a programmatic element, which is far more transparent than sometimes some of the yields with fixed income that are tied to opaque rating agencies, right? And having worked in a foundation and developed applications on these different chains, there's so many different flavors. They're not all inflationary. Some staking models are actually tied to deflationary tokens, but they have a limit after a certain period of time. The beauty is, if we take our time and do the research, you can actually learn what the staking model is supposed to do and how it ties to performance of the network and the chain. So I think that there's a lot of interesting opportunities there.
Thank you. So when it comes, let's get a bit global. Now, for the context, globally crypto ETP assets under management reached $155 billion, right around that, during the 5-week inflows streak that ran through early May 2026. Now, before a risk-off period drove the consecutive weeks of outflows totaling $4.21 billion. CoinShares flow data shows that during periods of macro stress, European allocators in Switzerland, Germany, and the Netherlands have consistently bought where US allocators sold, pointing to structurally different investor behavior across markets. What is the profile of the institutional buyer you're talking to today, whether in Europe, North or South America, Asia, or the Middle East? And what is the conversation you're having with allocators who are still on the sideline?
I'll take this one. I mean, I think the profile's changed. I think 6 years ago when I started at CoinShares, it was only the adventurous or those with the most flexible investment mandates that could buy Bitcoin in an ETP structure. So it would have been retail to quite a significant extent. And then hedge funds or family offices, they have the most flexible mandates. That rigidity that you see in pension funds, for instance, has really slowed down the uptake in that part. But I think that's changing now. We do have several clients that are pension funds as investors in our ETPs now, and we're seeing a significant change in mentality. I mean, a lot of the big banks now that embraced Bitcoin and Ethereum, a lot of the wealth managers we speak to are now putting our products on their platforms. So there's been, I think, a big change, particularly in areas which have been incredibly cautious in the past. I run the survey every quarter and it asks clients why they invest. And if you look back to 2021, when I started the survey, around 60% of the responses were saying they were owning Bitcoin for speculation. Now that is only around 15% of people use it for that reason. Around 40% say they're buying it for diversification, and another 30% say they're buying it for access to DLT. So the mentality has changed, and I think that's partly reflective of the kind of people that are buying and a better understanding of it. So particularly those with, I'd say, sort of more rigid mandates of buying Bitcoin. And we can see, if you look at 13F filing data, we've seen a big change. Actually, hedge funds have been selling over the last quarter. The 13F filing data, we've seen hedge funds selling quite a bit. They play the basis trade. Wealth managers don't do that. Also, governments don't do that, or government institutions. So I think it's now 3 out of the 8 university pension funds in the United States now hold Bitcoin, and we have states now buying sovereign wealth funds like Mubadala owning Bitcoin. So there's been, and I think that's really signifying that Bitcoin is becoming a kind of a much more accepted asset.
And I think you always mentioned Bitcoin, James. That's right. I think it's focusing so much on Bitcoin currently. We talk about digital asset, but it's really, at the end of the day, if you look at flows in Europe, I think it's 95% this year Bitcoin, despite this product breadth. it's a great entry point. But my view is that once the market recovers again, we will see a bit more diversification again going forward into not necessarily by pension funds or asset owners. I think they will stick to Bitcoins, and I think with those with this segment, with those client segments, they might even go diversified, with a basket index solution, maybe even active, because they don't want to take the investment risk. But when it comes to the pure ETPs, the pure single crypto ETPs, it's mainly Bitcoin only. But I can echo what James says. I probably we see similar flows from our investors. It's really much more diversified than when I started 5 years ago, and that's very refreshing to see. But it all comes down to education as well, and sometimes even I think wealth managers, private banks, they're realizing they might lose out versus competition as well, and there's a certain pressure from the final client too, which is definitely helpful for us. And the ETP is also a beautiful instrument of keeping assets in house rather than losing clients to direct crypto product offerings.
Yeah, absolutely. I think I think education is critical because I met, for instance, here in Zurich on Thursday, or I believe it was on Tuesday of last week, with the chief investment officer of a private bank, and he was still of the mind, crypto no, Bitcoin no, I don't get it, right? So you still have individuals like that. However, he did say that many of his clients, particularly whenever the market changes and they start to be exposed to record prices, they basically demand how they can get exposure and why he or their bank as an asset manager are not providing these solutions. And I can guarantee you that when an investor like that determines to make the decision to enter the market, they will not be doing it by heading onto a decentralized exchange, firing up a wallet on behalf of themselves, their institution, or their client, and then buying. They will do so through a regulated wrapper like an ETP. So there is an educational process. It does not help whenever we have the extreme of volatility that we've been having in the markets as of the last few months. I mean, we have to keep in mind that about 6 months ago, probably closer to 9 months now, September 2025, we had hit all-time highs, pretty much, certainly whenever it came to the price of Bitcoin. But in the interim, what has happened? We've had a few DeFi exploits, but at the same time, we are in the midst of a very volatile macroeconomic situation, a war in the Middle East that seems to not want to start but can't end. And that is also impacting one of the most valuable commodities, oil. And yet the asset still is holding value in spite of this. So I do agree with what Bernhard said. We are not in normal economic times, and the pricing around the digital asset space and Bitcoin in particular is exhibiting an unnatural volatility. But when a sense of stability returns, or whenever education catches up with what the technology is, I mean, ultimately, this is a programmatic, unmanipulatable, unowned store of value. When I say unowned, unowned by one ministry or treasury or central government, central bank. So it is actually, in my view, an asset that should have more value in times of volatility, not less, speaking specifically about Bitcoin. But people have to get comfortable with that, right? And that comfort takes time.
Yeah, I mean, I agree with this, with a lot of points. Actually, with what you're mentioning, Andrew, this point of know-how and education and understanding what you are investing into and understanding the technology, its risks, its limitations, its benefits. It is quite, it's still quite a challenge even after 15, 16, 17 years since crypto industry in general came to be. And I think this is also both on the supply and the demand side, meaning wealth advisory most of wealth advisors are still, let's say, old school guys that control the flow and control the assets under management. And they are still maybe blocked or hesitant, too much of a hesitation still there to offer something as a digital asset, because it is still something as an alternative asset which you should, maybe not should add to your core model portfolio. If so, if you insist, then maybe just Bitcoin, because it is the store of value, the safest bet. But the lack of understanding is both on both sides, meaning the wealth advisory and also the investors. Both do not have the same level of understanding. And in a way, with what we have observed with our clients is that younger clients are, like the younger investors, are more open to invest in digital assets, in the crypto industry, in the technology, in the fundamental values that are behind the underlying assets. And this is not as the case with some of, let's say, private banks that are, in this sense, old school, which are still reluctant and hesitant, probably largely due to this fear of liability, compliance, and the likes. So approaching this is going to take time until it bears any fruits. So maybe the next 2-3 years are going to bring this shift into this currently very highlighted generational differences between older investors and younger generation, who is now maybe inheriting some of the wealth of family wealth, like with family offices, that are more open to digital assets, which should give, of course, a sort of a boost to all the products that are coming into the markets over the next 2 to 3 years.
All right. Then let's delve more into the product side of the matter. Even deeper, right? The ETP wrapper has expanded significantly. 21Shares, which listed the world's first physically backed crypto ETP in 2018, right, if I'm not mistaken, now manages over $12 billion globally and launched the strategy yield ETP on Euronext Amsterdam in February. CoinShares offers staking ETPs on Ethereum, Solana, say, all at zero management fees. DeFi Technologies through Valour runs over 100, if I'm not mistaken, 102 ETPs covering 74 unique digital assets listed across Europe and the UK and so on. Venionaire Capital launched VLON in September, right, 2025, an EU BMR compliant layer 1 index with Compass Financial Technologies as the independent calculation engine. So issuers are racing to bring new structures to market across multiple jurisdictions simultaneously. From an issuer, research, and investor perspective, what is the honest answer on which of these product structures has real institutional demand behind it and which ones are supply-side bets? And what does the next product look like that none of you have built yet?
Maybe I take this to start off with. I think we need to take one step back. The beauty with the ETP or ETC structure in Europe is that you can run a large amount of products quite efficiently, right? If it would be ETFs, all separate funds, that would be not possible. So from a first point of view, it's very efficient structure in Europe with the ETP structure, or you can also call it ETC structure, doesn't matter. And I think our approach has been, why do we have such a large product of 60 products, is we want to give our investors choice. Not every single niche ETP might fit an institutional asset owner tick the box exercise. Yeah, it's like we said before, it's at the moment probably Bitcoin only, and then maybe a couple of layer ones, and going down the line, we also would expect indices and baskets to be eligible products for institutional investors. But having said that, there are, in particular in Europe, many dedicated crypto asset managers out there who are also institutional investors, and they want to have choice as well because they run active crypto strategies, and they might go a bit further down the market cap as well. So that's the reason why I think all of the products have a kind of institutional right to exist. Albeit, I must admit, many of the products we have are more being bought by particular retail investors. But it is an efficient structure, and clearly we also do our homework like every ETF issue and other asset classes is doing, that we sometimes also have to take products away from the market, which I think is an important exercise to free up resources for new ideas. But overall, I think it's important to offer that choice to investors. And like I said in the beginning, thanks to this ETC structure in Europe, it's possible to do this very efficiently. I mean, Hyperliquid is a great example, right? I mean, it's very niche, but it has been an amazing success not only here in Europe but also in the US already, and that's still more a niche investment as well.
I mean, the question, to my understanding, is where does real demand lie, and what is supply side bet when it comes to issuing different kinds of products. I mean, spot BTC and Ether, of course, in my opinion, have real demand, but the majority of what's out there when it comes to digital assets, token coins, protocols, I dare to say most of it would fall under this category, that it's a bet that the demand will follow. Or we have, if I'm not mistaken, 60, 70, 80 altcoin ETFs either in the pipeline or already launched, approved. But it is not comparable to BTC, its standing, its function, as well as with Ether and the network Ethereum as a general compute network. So as Bernhard mentioned, I think every product will find its user or client base. There is a buyer or seller for almost everything. Nasib, you mentioned our VL1 index. The idea in this context was actually to offer something to our institutional clients that is beyond a BTC or Ether itself, that is reflecting the development of the foundational layer of the entire crypto industry, which are the major L1 protocols. So having that in a novel way with a hybrid methodology that goes beyond just merely quantitative characteristics or elements should help the institutional investor to gain this broader exposure into quality projects that are meant to be longer lasting. Hence, they are underpinning the entire crypto industry. Without L1s, there is nothing else. Everything else is built on top of L1s. So different products will be bought and sold, but not in the same way, not in the same volume or capacity. But there is something for everybody out there, which is, I think, a good point to have for the coming maturity or further growth of the market over the next 2, 3, 5 years.
I think you have to make distinguish between retail and institutional investors. You could make, not to, I suppose, diss retail investors, but they're probably going to be less thorough in terms of their due diligence of different tokens you might decide to create an ETP of. There's definitely a market for that, I think. But we're certainly seeing on the institutional side, there's a much greater demand for a credible investment thesis backing up the token. And I think for us, we've decided to take that approach more than just sort of choosing anything to list with the hope it might go up. I think you could, on an extreme level, just say that Bitcoin and Ethereum combined can do pretty much everything the other cryptocurrencies can do. But then we come up to potential margin issues as those assets grow. So you have to explore further. I also think whilst Ethereum and Bitcoin can do everything, else that the others could do. Others will define a niche for themselves. So for something like Solana, at the moment, it's probably primarily meme coin trading. For something like Hype or Hyperliquid, it is an online derivatives platform. So I think, there are examples out there where assets or tokens are starting to find a niche for ourselves. And that, I think, is where we are focusing on, primarily because when you go and speak to clients, it's a much easier conversation when you can say, look, here's the monthly users, here's the income it's generating. So I think that area is, an easier sell for us.
Look, I understand the question. I think the focus, though, has to be we give access. We don't necessarily pick the winners and losers because we don't actually know where the winners and losers are going to come from. You can follow trends once they've been established, but the idea is when you see a promising project, you want to support it by providing it with liquidity and ensuring that both retail and institutional investors can participate. For starters, institutional investors by and large weren't allowed by way of corporate policy to hold digital assets in any way, shape, or form, even just a few years ago. So the expectation now that all of a sudden that institutional investors would be far and above retail, that just doesn't necessarily meet with the reality of the market. But that's changing. The second thing that we're going to see that is changing is if you were to say 5 years ago, a company like Tether would be the 17th or 18th largest holder of US treasuries in the world, above countries like perhaps Germany and South Korea. No one would believe you. But today, that's a reality. And do you know what else is a reality? The main chain upon which Tether mints its USDT token is certainly not Bitcoin, because Bitcoin is not programmatic in that way. It's not core Ethereum, because gas fees wouldn't allow for that. It's a chain called Tron, right? So we have to serve our industry and also provide education so that investors know where the digital assets they're investing in have real use applicability. That is our job. We make it available, we provide the education so people can enter. If we were always waiting to enter after a product has been long established as a commodity, that's something that BlackRock can do just because they have such an inordinately large assets under management, regardless of asset class. BlackRock could do what they do, whether it's dealing with World Bank sovereign debt, whether it's dealing with NVIDIA shares, or whether it's dealing with Bitcoin. But as for other asset managers, we try to be strategic and provide value as efficiently as we can and make sure that any opportunities that we see that are coming up in the digital asset space or other spaces, we're able to provide instruments that give investors both retail and institutional access. And I think that's what we all do quite efficiently. It's just a matter of, at the end of the day, how do you assess whether you've been successful or not? Now, I think we would all agree that if one of our firms had started a Bitcoin ETF or ETP back in 2011 and had managed to capture 10% or 20% of all outstanding Bitcoin into that product, we'd be considered geniuses now. But in the absence of time machines, we try to provide accessibility to those instruments that have maximum use. There's other chains. You've got Arbitrum, you've got Base coming up. All of these have significant value. I just learned that our 50% of RWA are minted on Arbitrum related chains. Now, Arbitrum is an L2, and Arbitrum is also one of the biggest platforms for the issuance of what you call L3s via their Orbit chain. So we are going to see increasingly new products that have maximum utility growing in this space, and we have to be ready to give investors access in whatever form they choose.
So the lights seem to have gone out here in this room for some reason. Apologies. I think we have to be slightly selective, though. I'm quite careful. The problem with the crypto industry is I think one of the guys on my team did some analysis and worked out there's nearly 30 million different tokens on exchange and on the cryptomarketcap.com. And so there are just so many to choose from. And it's very easy to, I think, get caught up in the romance of a particular token and it end up being nothing. Or a flip side of that, you can look at the fundamentals of something and see it's very compelling. So I think Tezos is a really good example of that. A technically brilliant asset, but sadly not many people are using it. And this is a trap I think a lot of people have got into. They find an asset, they see it's technically brilliant and say, okay, the users must follow. And that's not happened. And that's one of the biggest problems. You do have to strike this balance between those that are technically brilliant and hope to some extent that some of those might really catch on. But the reality is most of there are assets out there that are technically not great that have massive user bases. And I think actually Ethereum is one of those. It has its technical challenges. Key management is leaving, but it has this massive network, and network effects are incredibly important. And you have to take that into consideration. And it's actually a very tough game, I think, to pick out at the moment the winners. And that's why I state like something that really defines a niche for itself is likely to do well.
Yeah, I agree. I think without any, research-based view of the world, it's difficult because then you start issuing possibly underlyings nobody's gonna buy or nobody needs. I think the beauty with ETPs is that you also have this external quality control with the traditional exchanges because you can't list anything, right? You have to have certain market cap liquidity and track record rules, which I think is important. And that gives you already well, at least an underlying universe that it's easier to manage at the end of the day. But probably down the line we're gonna see also an uptick, but it's also looking into the future already. In my view, we're gonna see an uptick, especially when the correlation intra crypto correlation is going down off basket and index products in the institutional world at least. And then you have already a bit of a more diversified investment rather than betting on single underlyings.
Yeah, I mean that is the reason this diversification and focus on the balance between quality and network effects of an underlying. That was the reason why we created this hybrid methodology where we incorporated fundamental analysis that is characteristical to digital assets, which is not the case with the majority of crypto indices, allowing the institutional investors or allowing for creation of structured products on top of it that reflect this without or lowering the operational burden for everything down the line, which means such specific crypto indices as VL1 reflect this on a dynamic basis, meaning the protocols come and go, projects come and go. They may have very strong fundamental technical quality and stability, but there are no users. So this lowers the value of an underlying asset of such a protocol. So keeping this, keeping an eye on such developments, and crypto is very, very fast paced compared to the TradFi markets. This was the reason why we actually approached this creation of hybrid methodology, not just focusing on quantitative elements like market cap and the top 5, top 10 market caps. And this is going to get, I think, increasingly harder over the coming years because the institutional investor will have very, very hard time distinguishing between quality and pure garbage out there because, as James mentioned, millions and millions and millions of coins and tokens are out there. So how do you make a compelling investment strategy or thesis where you're going to put your money in? And I think in this context, certain crypto indices are very, very valuable too, to give this sort of guidance or navigation through this crypto industry, which is very, very complicated as compared to 5 or 6 years ago.
Let's talk about the future. Grayscale's on data puts crypto at less than 0.5% of US advised wealth. Bitcoin ETP inflows, in the meantime, have gone from nearly $4 billion to year-to-date to $1.2 billion in 2 weeks, driven almost entirely by US-based selling, while a MiCA regulatory cliff is landing simultaneously. The structural opportunity is the largest it has ever been, and the near-term flow picture is the worst it has been all year. What specifically has to happen in the second half of 2026 for advised wealth to start moving into this asset class at scale? And what are the biggest obstacles standing in the way?
Perhaps one of the major ones is that the world is not on fire and not everything is breaking down left, right, and center. I mean, the crypto markets are just a tiny portion of world markets, financial markets in general, and as such, they are not isolated or immune to bigger picture or macroeconomic developments. So, as we have seen over the past, let's say roughly 12 to 16, 15, 16 months, there have been periods of very high correlation, but also decoupling with TradFi markets. And crypto is essentially, at the bottom line, it is a software. So every protocol, it's a software combination of course, software, hardware elements. And I think Andrew mentioned it in the beginning. If there is a price recovery, flows will follow price. So assuming that BTC stabilization returns or resumes, I think inflow narrative will pick up speed. I think, in my view, this is one of the first crucial elements, which is affecting directly the confidence and the risk appetite of every sort of investor, big and small alike. I think we mentioned this, let's say, know-how education catch-up between also wealth advisors, but increasingly also on the institutional or investor side, which also needs to catch up. But I think that's a bit of a longer-term play and not something that is strictly reduced to the next 6 or 8 months.
Yeah, I mean, I think from my perspective, I've been on the road quite a lot, seeing clients recently. I don't think really any of them are particularly fazed by the moves in markets. We're spending a long time helping them understand what's driving prices, and Bitcoin, it's probably, and other assets, it's geopolitics to a certain extent, just like many other traditional assets. It's monetary policy action as well. Bitcoin is hugely influenced by that. And recently we've had, and then also one of the big things, particularly for Bitcoin, is the whale cycle. We've had $40 billion worth of selling since October. And that's put quite a lot. That's been the primary reason, actually, why we've seen a lot of selling pressure. We do think that will ease in the years to come. And then we, at a time, we've gone from 2 months, within 2 months, going from 2 rate cuts this year to nearly 2 rate hikes this year. And so much more hawkish monetary policy, I think, is quite damaging for the short-term prospects of Bitcoin pricing. It is very sensitive to that. If you look between 2018 to 2022 to 2024, there were virtually no inflows. And that was exactly timed when monetary policy was very hawkish in the United States. And we're there now. I'm not sure actually the Fed will hike rates, but certainly that's a limiting factor on potential price appreciation for now, and will limit any kind of potential price breakout, at least until the Fed's much more dovish.
Yeah, I think not a lot to add. I think that's exactly how we see the world as well. Probably we also need a bit of a change of sentiment. There's a negative sentiment also around strategy, which is influencing the Bitcoin market. Although the size of the sell was not large, but it's all about sentiment, right? I think ETF flows, once they reverse, that's going to be a good sign, and Clarity Act might be signed in H2. But like James said, if this geopolitical situation doesn't get better, if the rate outlook is compromised, it's difficult to see a catalyst to the top. On the other hand, we still think we're going to see a rising Bitcoin prices towards the end of the year, but the next couple of months going to stay challenged. And Igor mentioned education. I think it is important, and we shouldn't underestimate it, because many of the wealth managers, private banks we are talking, are telling us, if we don't educate our bankers, our wealth managers, if we don't understand it, we can't define it as an asset class. So I think it's an ongoing topic, but much more needs to be done on the educational front as well. And then once people understand what they're buying, and also the purpose in a portfolio context, that might change the advisor model as well.
From my perspective, I tend to have a bit of an absolutist view of the space. I think anytime you look at finance in 6-month or quarterly windows, you will make bad decisions. This has been the case with silver. This has been the case with the internet. I remember there was a time period when shareholders were livid with Amazon because Amazon was not making money. It was not generating revenue, and its stock price was depressed. And Jeff Bezos famously said that the business is not the stock price. And in this same way, the technology is not the token price. And the reason why I say that is people forget blockchain actually serves a purpose, a very, very unique purpose. Perhaps we don't need 13 million layer ones or whatever that figure is. But at the end of the day, it's ironic because I think of all the equities that existed in 1900, only 5% or 10% of those equities exist today. But if you look at the programmatic deployment of blockchains, they are actually designed to be somewhat eternal. They exist programmatically to serve a purpose. Blockchains are databases, first and foremost. That's it. But they're databases that serve a very specific purpose and have superpowers in that they are immutable. That means you can't change the data that enters into them. And for this reason, it's why we can put our forms of money, securities, investments on chain. So first and foremost, when I look at the space, I think, is it going to go away, right? And the answer to that is it won't go away because the technology is basically transformative. So when you evaluate it in that prism, a lot of these variations in price, as painful as they can be as asset managers and day to day, we always want markets to go up. We forget that in traditional markets, they have triggers and switches that stop the market from going down. But we don't have those unnatural automated market interventions in the world of DeFi. So when assets drop in the world of DeFi, they can accelerate lower much further than traditional assets. But at the end of the day, the key thing to keep in mind is the technology has a purpose, and we are seeing more adoption, not less. If any of us who are in this call back in, say, 2020 were to see the total value locked, were to see the retail utilization of stable coins, were to see the utilization of blockchains in terms of RWA 5 years hence, I don't think many of us would believe the degree of adoption. So my advice, given that question about the future, is it's inevitable the technology will be integrated. There will be losing chains, without a doubt, but the value is not something like an NFT, which is one implementation of the blockchain. The blockchain itself, the tokens, the gas fees that are used to power and validate the chains are incredibly useful, and they're needed. And we are going to see increasingly more and more finance move onto these layers. And the value in 5 years and 10 years will be even more than I think we could have imagined. So that's the prism through which I like to view the space.
All right. We have covered a lot of ground, and now it's time for the Q&A. We have questions coming in from the audience, and I'll read them out. And a quick note for those who are watching: if you have not submitted your questions yet, you can write a comment, right, and ask it this way, or you can write those directly to me, as happened already. So I have two interesting questions. Both are RWAs related. We have mentioned them already, and it's actually very interesting. So RWA-based ETPs, they do not exist at scale yet. Which asset class gets there first? We have private credit, real estate, commodities, and so on and so forth. I would also add sovereign debt, and yeah. So basically, the question was which asset class gets there first, and probably I would also add what kind of a picture we can anticipate, if not throughout the next 6 months, then maybe a few years. Sorry, you're muted, James.
Sorry, I'll add my 2 cents to this. If you look at the ETP world, there are ETP versions of most assets. There are ETP REITs, ETP fixed income, ETP equities, a whole range of different things. They're already there in the ETP wrapper. Do we need a real world asset, then tokenized and then turned into an ETP? I'm not so sure. I mean, I really like the tokenized asset theme. I think there's great opportunity in ETPs for tokenization. I mean, we're looking into this subject deeply. I mean, if you look at how much stablecoins are going to grow, if you look at the various forecasts amongst quite credible companies like McKinsey's, how big the tokenization, the real world asset industry will grow up to trillions of dollars in the next 4 or 5 years, then there's huge opportunities. But I'm not necessarily sure it would be ETPs creating, this double layer of ETPs and tokenization. I think that there'll be some interesting ETPs that will invest in companies that are doing the tokenization. That, I think, is a really interesting space.
%100% agree, nothing to add.
Yeah, I agree. I think we often forget that the asset classes that ETPs will go towards will be the ones that are most liquid. And RWA, by definition, are wrappers of traditional securities. If these instruments are not liquid, then it becomes very difficult to make an exchange traded product around them. And I think for those of us who've worked in the tokenization space, one of the biggest challenges that we have is actually secondary market liquidity for these instruments. So for us to create a wrapper of an instrument that is illiquid would inherently be risky for the investors, A. Then the second thing is, even though all of us here are very interested in the digital asset space, we can't deny that the traditional exchanges have solved liquidity and capital flows far more to this date, to this point in time, than the digital asset exchanges. So as James correctly stated, an RWA of an Apple stock doesn't need an ETP of that RWA because there are many index products and funds that already contain the Apple stock.
If this is it, then I think since we don't have much time left, it's actually we should have finished at 2. Maybe just one last question, which is also interesting, and I think it makes a lot of sense, especially for the report. It's about the future again in the RWA-based ETPs. So it sounds so. I will just read it. In 10, 15 years, if ever the RWA-based ETPs are a standard allocation in institutional portfolios, what had to be true about custody infrastructure, legal standardization, and liquidity provision? We have mentioned already briefly. That is not true today, right? So custody, legal matters, and legal side and liquidity.
Well, if it's still an ETP, which is linked to a token that's linked to a RWA, it's gonna be the same mechanism as today. But I would reckon in 15 years you would buy the token directly if RWAs are tokenized, if I understand the question correctly. But then if you do an index, for instance, or if you do a basket and you have any tokenized assets in there, the tokens are custodied in the same way as let's say a Bitcoin ETP today, I guess.
Yeah, Nasib, whenever we're talking about RWA, we have to understand that most of the time they're wrapping things that are considered as securities, and securities have an entirely different treatment under the law than commodity or utility tokens, for instance. So the way it is right now, the security tokens mainly have to be minted in a particular protocol. Most of the time it's the T-Rex protocol 3643, ERC 3643, that embeds KYC and AML logic or information somehow into the token to restrict its movement. The the upshot of that is it's hard to move the tokens around. So because it's hard to move the tokens around, it generally means that people have to buy and transact in a siloed system. And anytime you have restrictions like that, it sort of limits liquidity and limits a degree of interoperability. Until that is addressed, you will have successes in the industry, like a firm like Securitize, for instance, is a great success because they've got a lot of market. They've got a big market, huge market in terms of the instruments, huge markets in terms of geography. But it makes it very difficult for a firm that's based in Europe, for instance, to include securitized assets in their product and distribute it to people that might not be regulated to buy that particular security. So this is one of the underlying challenges of the RWA space, whether it's real estate, stocks, debt, it doesn't matter.
Thank you. Does anyone want to add something? Otherwise, we can just wrap it up.
No, I agree with everybody. Not to repeat not necessarily all the points. It's been a great discussion. Thank you for the invitation. If you or anybody from audience wants to reach out to connect with me, please feel free to do so. DM me on LinkedIn. It's been a great topic. Thank you again.
Thank you very much too. Yes, this is the end of the session. Big thank you to all of you as well for bringing your expertise to this discussion. And yeah, as Igor mentioned, anyone who is watching, please leave a comment, right? Or you can also reach out directly to the guests. And yeah, so thank you very much. I think Bernhard is also experiencing some difficulties there, but this is the end of the session anyways. Again, I will turn this into a bigger episode, and then there will be a lot of content coming out of it. Again, thank you very much for your time.